Welcome to the deep dive. So this week, Ghana's economy, it's thrown us a bit of a curveball, hasn't it?
It really has.
The cedi's been strengthening against the dollar, which, sounds great, fantastic even.
Absolutely. On paper.
But then you go to the market and, well, prices don't seem to be getting the memo. They're not really falling in line.
Right. That disconnect.
Exactly. So let's try and unpack this because it's just one of the really fascinating things we're looking at today.
Indeed. This week's economic picture in Ghana, drawing from our sources, we've got news reports, plus some really good analysis from IMANI Ghana. It paints this, well, complex scene, a country navigating tricky economic waters.
Definitely.
So our goal today is really to cut through that noise, look past the headlines, and give you, our listener, a clear sense of what's actually going on, what really matters here.
Think of it as your shortcut. We've done the sifting, the digging through the reports, so you get the key insights without, feeling overwhelmed. And we've got quite a bit to cover. We're going to dig into President Mahama's first 120 days, the promises made there. Then this whole issue of the stronger cedi but sticky prices.
The big puzzle.
Yeah. And then the upcoming Ghana Automotive Summit, plus the government's big plans for boosting cocoa production.
Quite the agenda.
So, yeah, buckle up. Let's dive in.
Okay, let's start with President Mahama's 120-day social contract. So the government's position is that they've successfully delivered on all 26 initial promises.
All 26 in 120 days.
That's the claim. Across economy, governance, education, social services, natural resources, the whole gamut. And it's gotten a lot of media play, naturally. My Joy News reported on it. The president's made statements.
Right. And, on the surface, hitting all those targets so fast sounds, well, pretty impressive.
It does.
But as always, there's more to it, isn't there? IMANI Ghana, looking at this, they acknowledge the progress reported.
Yes, they do note progress.
But they ask this really critical question. Are these actions actually building a solid foundation, like for long-term economic stability, especially thinking beyond the current IMF program? It's not just about ticking boxes, right?
Precisely. That's the core question. Sustainability. So if we zoom in on the economic promises specifically, there were 10 of those.
Yeah.
The assessment suggests 5 are fully done.
Okay, halfway there.
4 are ongoing, sort of in progress, and 1 hasn't been fulfilled yet.
Right.
And these tackled some big areas: macroeconomic stabilization, tax reforms, job creation, women's economic empowerment, reforming state-owned enterprises, SOEs, and promoting exports.
Which all sound like the right ingredients for, a healthy economy. But here's where IMLA adds that layer. They point out that even with these steps, some of the really deep-rooted weaknesses might not be getting addressed.
Exactly. What are those weaknesses?
Things like high tax expenditures, basically, revenue lost through exemptions and reliefs, the huge informal sector, which makes tax collection, well, tricky.
Over 90% informal, right?
Yeah, massive. Then there's duplication between government bodies, and maybe not always the best system for picking which public investments get priority.
That's a crucial point. Tackling those underlying issues is what really leads to lasting change. Now, the National Economic Dialogue, that was another promise fulfilled. It brought people together.
A positive step, bringing stakeholders in.
And recommendations from that dialogue, they've reportedly been fed into the 2025 budget. We're seeing proposed changes to the Public Financial Management Act, the Fiscal Responsibility Act.
Which looks like progress, strengthening the rules.
It does. But IMANI injects a note of caution. They say, look, having new laws is one thing.
But enforcement is another.
Exactly. Unless you tackle the politics in public procurement, the mismanagement sometimes seen in SOEs, and strengthen the oversight mechanisms, well, even the best fiscal rules might not be enough.
Yeah. The rules need teeth, and they need to be applied consistently.
It's about making sure those legal changes actually translate into better spending discipline, reducing government arrears, getting better at collecting revenue domestically. That's the real test.
Okay.
Then you have the 7 big flagship economic programs. We're talking nearly euro 19 billion allocated.
Wow, that's a lot of money. What are they targeting?
Big stuff. Infrastructure, the big push, a dedicated women's development bank, several job creation schemes like Adwumawara, the National Apprenticeship Program, the 1 Million Coders Project, Gold Bod, and the Agriculture for Economic Transformation agenda.
Huge ambitions. But IMANI has concerns here too.
They do. The main worry seems to be about, well, effectiveness and oversight. Are there clear ways to measure if these programs are actually boosting productivity? Is there enough transparency, enough oversight to make sure that euro 19 billion is used well?
Right, because without that.
Without those checks and balances, there's a risk these programs could actually add to the fiscal pressure instead of driving the sustainable growth they're aiming for.
Okay, makes sense. What about taxes? That's always a big topic.
Definitely. So the government scrapped the e-levy, the emissions levy, and that 10% tax on betting winnings. These were unpopular taxes.
Very unpopular.
But removing them means less revenue.
Right.
IMANI estimates around GH 2.6 billion less. The government plans to offset some of that by lowering the threshold for tax refunds.
But again, IMANI points to the bigger picture.
Exactly. Just removing those specific taxes doesn't solve the fundamental problem of weak tax compliance. With so much of the economy informal,
Over
the
90%.
tax base is just too narrow. So unless you improve how the Ghana Revenue Authority works, simplify the system, and find ways to bring more businesses into the formal net, these revenue gaps will likely continue.
It's a structural issue.
It is. Then there was a promise to review import duties on agricultural and industrial equipment. It was mentioned in the budget. But IMNI notes that concrete action hasn't really happened yet, and their argument goes deeper. They say it's not just about the rates of the duties. It's the whole complex system. Various levies, non-refundable VAT, lack of clarity on who gets exemptions, all that adds costs for businesses and can put investors off.
So tinkering with rates isn't enough. The whole structure needs a look.
That seems to be their point.
Yeah.
Now, the 24-hour economy policy, another key initiative. The idea is to boost industry, create jobs, get businesses operating around the clock.
Sounds dynamic.
It does.
Oh, yeah.
And it's reportedly in progress. But IMANI stresses that the supporting infrastructure, legal, economic, isn't quite there yet.
Meaning it needs more than just a catchy name.
Pretty much.
That-
They highlight the need for a proper, broad industrial strategy, one that tackles the big, persistent issues: high interest rates, inflation, the volatile exchange rate, energy costs, unreliable infrastructure.
The fundamentals.
Right. Without dealing with those, the 24-hour economy could hit the same roadblocks as things like special economic zones have in the past.
Okay, and youth jobs. There were specific programs mentioned.
Yes. Adwumawura, the National Apprenticeship Program, the 1 Million Coders Initiative, about GH euro 500 million budgeted there.
Significant funding.
It is. But IMNI draws a parallel to past programs, like NABCO and UStart. They also got substantial funding.
But the long-term impact was limited.
That's the concern. That these new programs might also end up channeling people mainly into the informal sector, which, remember, is over 80% of employment already. It provides some immediate help, sure, but maybe doesn't create those secure, formal sector jobs that broaden the tax base.
Right. Addressing symptoms rather than root causes, perhaps.
That's the potential risk they highlight. And finally, the Women's Development Bank.
Yeah.
Seed funding of GH euro 51.3 million. The goal is noble: help women-led businesses get finance.
Which is often a major hurdle.
Absolutely. The model is expected to be like the Development Bank, Ghana, DBG, lending to other banks who then lend onward.
Okay, but will that translate into affordable credit for women entrepreneurs? That's the key question, isn't it?
It is. IMNI raises that exact point, considering DBG's own rates and the general high cost of borrowing. Will it really make a difference? Plus, they note, finance isn't the only barrier.
What else?
Many women entrepreneurs operate informally. They often have lower revenues, might lack collateral, and sometimes face perceptions of being higher risk.
So access to credit is just one piece of the puzzle?
Exactly. IMNI argues you need more. Help with formalizing businesses, targeted support for business development, help moving into higher value sectors. Just offering loans isn't the whole solution. They also mention, the mixed track record of similar development finance institutions in Ghana historically.
Right, so proceed with caution and a comprehensive approach.
That seems to be the advice.
So pulling this section together, we see a government taking action, trying to deliver on promises, which is noted.
Yes, activity is happening.
But running parallel are these deep structural economic challenges. And there's this tension, isn't there, between wanting quick results and needing fundamental governance reforms, better revenue collection, spending control, stronger oversight to really hit those fiscal targets sustainably.
Absolutely. The key takeaway, as the IMANI puts it, is that while the initial actions are there, real sustained stability depends on fixing those foundational weaknesses. They offer clear recommendations, too.
Like what? Briefly.
Prioritizing governance reforms, making sure flagship programs are actually assessed for productivity, genuinely reforming taxes, both spending and compliance, and properly analyzing the risks of SOEs before deciding their future.
Okay. Important points. Now let's pivot to that issue that's probably confusing a lot of people. The exchange rate is down, but prices are still up.
Yes, the lag effect. It's a common frustration.
So the positive news first, the cedi got stronger, down to around GH Euro 13 to the US dollar in early May, right? From over GH Euro 15 just back in March.
Correct. A noticeable appreciation, and several things fit into that.
What were they?
Well, globally, the U.S. dollar itself weakened a bit. Gold prices went up, which is good for Ghana's earnings. Plus, the Bank of Ghana has been actively buying gold for reserves, the gold purchase program.
Yeah.
Their gold holdings actually increased slightly between December 2024 and April 2025.
Oh, interesting. From about 30.5 tons to over 31 tons.
Something like that, yeah. Then there's improved investor confidence, maybe linked to those PFM law changes we mentioned, progress on debt talks.
Okay.
And also, apparently, some traders decided to sell off dollar holdings. So a mix of factors.
Like confluence of positive drivers for the cedi. But why aren't prices reflecting this? Why are things still expensive?
This is where we get into price stickiness. It's a standard economic idea. Businesses often react fast when costs go up, like when the cedi weakens, prices shoot up quickly.
You've all seen that.
But they're much, much slower to bring prices down when conditions improve. There's an asymmetry. So the takeaway is, a stronger cedi doesn't instantly mean lower prices. There are reasons for the delay.
Okay, so there's this. Upward stickiness. Why? What causes it?
One big factor is what economists call menu costs. Literally, think about a restaurant having to reprint all its menus if prices change.
Right, or retagging everything in a shop.
Exactly. Updating systems, maybe renegotiating supplier contracts. These little operational costs add up, especially if you're in a business with tight margins. So businesses hesitate to change prices too often, especially downwards.
Okay, that makes sense. It's a hassle and a cost.
It is. Then there's the inventory cycle issue. Many traders bought their current stock when a dollar was much weaker, maybe around that GH15 mark.
Ah, so they paid more for the goods they still have on the shelves.
Precisely. They need to sell through that older, more expensive stock before they can really afford to lower prices based on the current stronger cedi.
Okay, that's a practical constraint.
Definitely. And remember, the exchange rate isn't the only thing driving costs. Businesses are still dealing with other pressures.
Like what?
Rising utility tariffs, high transport costs, and the VAT structure is still something the Ghana Union of Traders Association, GUTA, is pushing to get reformed.
So even if the cedi helps on one front, these other costs are pushing prices up.
They can be, yes. And one more factor, plain old uncertainty. After years of the cedi bouncing around quite a bit.
Volatility.
Exactly. Many businesses are probably cautious. They might wait to see if this cedi strength is really going to last before they commit to major price cuts. They don't want to lower prices today, only to have to hike them again next month if the cedi weakens.
Understandable caution, given the history. So what's the response been? Have the business groups said anything?
Yes. GTA and the Association of Ghana Industries, AGI, met with the trade minister. They basically pledged to start adjusting prices downwards within about 60 days.
60 days? Why?
As they clear out that older, more expensive stock we talked about. The GOTA president specifically said, it's not unwillingness, it's just the mechanics of the supply chain. But crucially, they stress that this depends on the cedi staying stable. Sustained stability is key.
Okay, so we might see some relief in the coming weeks, but it hinges on the cedi holding its ground. Let's shift gears now to the Ghana Automotive Summit. That's coming up soon, right? Early June.
Yes, June 3rd. That's the second one. And the theme is towards the future of mobility.
Sounds forward-looking. What's the main goal?
Primarily, it's about showcasing what's happening in Ghana's auto sector, highlighting progress with locally assembled vehicles, the different brands setting up shop, the potential for job creation through industrialization.
Putting the spotlight on the local industry.
Exactly. But it's happening against a backdrop of well-known challenges, things hindering the sector's growth.
Such as?
Low demand for new cars, some policy uncertainty maybe, and intense competition from imported used vehicles.
Right. Ghana does have policies to support local assembly, doesn't it?
It does. The Ghana Automotive Development Policy, GADP, under the broader manufacturing program. And remember, the Customs Amendment Act from 2020.
The one that banned importing salvaged cars and cars older than 10 years.
That's the one. The idea was precisely to shield these new local assemblers, give them space to grow, and encourage people to buy locally made cars.
But has it worked out like that? Are people buying locally assembled cars in large numbers?
It seems not as much as hoped. Despite assembly plants being operational,
Local patronage hasn't really taken off strongly. Affordability is a huge factor, as Dr. Isikalau Teta pointed out.
So they're just too expensive for many people.
That seems to be a major barrier, and those support measures that were envisioned, like asset-based financing schemes, tax reliefs to make them cheaper,
Right.
they either haven't fully materialized or haven't been effective enough.
Okay. And adding another layer, President Mahama recently mentioned possibly reviewing or even repealing that ban on older imports.
Yes, that statement created some uncertainty. It sends mixed signals, doesn't it? Because the local assembler's business case partly relies on limiting competition from those cheap used imports.
It's a tricky balance. You want cars to be affordable, but you also want to nurture a local industry.
It's a classic policy dilemma. The reality on the ground is that used imports dominate over 70% of the market. They're cheaper, readily available. Salvage vehicles especially are a big challenge for the new cars.
And are there strong rules on the quality or emissions of these used imports?
Apparently not strong enough. There's a lack of robust disincentives or regulations around emissions and roadworthiness for these older vehicles, which further tilts the playing field.
So what needs to change for Ghana to move beyond just basic assembly and build a proper automotive ecosystem?
Several things, really. First, a deliberate push to stimulate demand for the locally assembled cars. That almost certainly means finding better ways to improve financing access, making them more affordable.
Okay. Financing is key.
Policy clarity and consistency are also vital. The industry needs to know the rules of the game won't suddenly change. If that import ban is reviewed, it needs careful handling, perhaps with stricter regulations on what kind of used vehicles can come in.
Makes sense.
And it can't just be about assembly lines. Skills development is critical. You need more trained technicians, engineers, maybe even local parts manufacturers down the line. That adds real depth.
Building the whole value chain.
Exactly. And finally, the government could lead by example through public procurement, choosing locally assembled vehicles where possible. The key takeaway is that this summit needs to be more than talk. It needs real action on these structural issues.
Demand, affordability, policy skills. If those aren't tackled, it risks just being, ceremonial. Okay, let's move to our final topic. Cocoa. Big news about securing more land.
Yes, the finance minister announced a plan to secure a very large area, 200,000 hectares, specifically for expanding cocoa farming.
Wow, 200,000 hectares. What's the goal?
To get Ghana's cocoa production back up to the 1 million metric ton mark, trying to reverse the recent decline.
And what's caused that decline?
A combination of factors. Many farms are old. There are diseases like cocoa swollen shoot virus, illegal gold mining galamsey encroaching on farmland, and the impacts of climate change.
So the logic seems simple. More land equals more cocoa equals more exports.
That's the surface logic. But again, IMANI Ghana urges a deeper look. They argue the real problems are systemic inefficiencies and, crucially, disincentives within the cocoa value chain itself.
So just adding land might not fix the core issue.
That's their warning. It might not solve low productivity, farmer poverty, or the volatility of revenues. The key takeaway here is land is one factor, but maybe not the most critical one right now.
Okay, so what are these deeper systemic problems then?
A major one is the aging farmer population. Amamana's data is stark. About 3/4 of cocoa farmers are over 45.
74%.
Yes. And only about 4% are under 35. Young people aren't going into cocoa farming.
Why not?
It's physically tough work. The financial rewards are often low. Plus all the challenges we mentioned, climate change, pests, diseases. And they're often more attractive alternatives, whether it's small-scale mining, jobs in cities, or pursuing education.
It's a generational crisis brewing for the sector.
It really is. Then there's productivity and income. Average yields per hectare are quite low, around 450-odd kilograms. And IMANI found that at that level, more than half the farmers likely aren't earning a decent daily living income.
Which feeds back into why young people aren't interested. It doesn't pay well enough for the hard work.
It's a tough cycle. Another big issue, the price farmers get. Ghana sets a fixed producer price, but it's often lower than the price in neighboring Côte d'Ivoire or what they could get on the black market.
Leading to?
Smuggling. Significant amounts of Ghanaian cocoa get smuggled out to fetch a better price. And of course, galamsey continues to destroy cocoa lands.
So just allocating new land doesn't fix the aging workforce, the low income, the smuggling incentive, or the galamsey threat.
Exactly. Those are the real constraints. So what are the proposed solutions then?
What does IMANI suggest?
They focus on improving the existing situation. One key area is promoting agroforestry.
Planting trees alongside cocoa.
Yes. Integrating trees provides shade, helps the soil, makes the farms more resilient and sustainable long-term. They suggest scaling up successful models, reviving things like the Cocoa and Forest Initiative, and really pushing education and extension services for farmers on this.
A more ecological approach.
Definitely. Another recommendation: strengthen the existing programs for pest and disease control, like Cotapec and CRIP.
Helping farmers manage their current farms better.
Right. Expanding these programs, maybe with subsidized inputs and mass spraying, helps farmers tackle diseases and rehabilitate older trees, boosting productivity on the land they already have.
Makes sense. Get more from existing assets.
And thirdly, enhance farmer training and extension services more broadly. Equip farmers with knowledge on climate-smart techniques, responsible input use, environmental stewardship, recognizing that soil health, climate practices, they all link to productivity.
So empowering the farmers with knowledge and support.
Exactly. The core message is, tackling these deeper issues is crucial. More land on its own isn't a silver bullet for sustainable improvement in the cocoa sector.
Okay. Well, as we wrap up this deep dive, looking back at the week's economic news from Ghana, it really strikes you how interconnected everything is.
It really does.
You know, the government's social contract promises, the lag between the cedi strengthening and prices falling, the auto sector's challenges, the cocoa situation, they all paint this picture of complexity.
Absolutely. Economic development isn't simple. There are rarely easy, surface-level fixes.
And it really underscores the need for you, our listener, to think beyond the headlines, to ask critical questions about the underlying drivers and whether the solutions being proposed really get to the heart of the problem.
Well said. Are they addressing the root causes or just the symptoms?
So, maybe a final thought for everyone to chew on. If these short-term fixes, or perhaps politically popular moves, sometimes risk undermining longer-term stability, what are the really difficult, maybe unpopular, but necessary trade-offs that policymakers might need to face for Ghana to achieve genuine, lasting, and inclusive economic transformation?
That's a really important question, a tough one with no easy answers, but definitely worth pondering. We really encourage you to explore the sources we mentioned, IMANI, Africa's reports, the news outlets. Think about how these big economic currents might affect you or your interests.
Thank you for joining us for this deep dive.